Another chart example I wanted to discuss with you using an old chart. So this is 2020. So as per the regulations, we are allowed to discuss old charts. So we can discuss this. As you can see, this was the Corona crash. This is CDSL. Have a look at this cup with handle base. It's a very deep cup. Okay. The handle has only one bar in it, but that's okay. There is no fixed rules as to the number of bars in the handle. However, let's dig deeper. It's not as easy as it looks here. So you see a nice cup with handle on this weekly time frame chart. As usual, let us count the number of red bars inside the base. So the base starts from here. So 1, 2, 3, 4, 5, 6, 7, 8 red bars. How many are high volume red bars inside the base? Not a single one. This came very close, but we can consider that as low volume red bar. Out of 8, not a single bar uh, is high volume bar, even though this was that Corona crash. So which means the base still has strength in it. Second thing, since this low has undercut this low, this has caused a base reset. So this is base number 1, which is an early stage base, correct? So those are the two factors which are in our favor. Now, since this has been very volatile price action, you don't see tight closings and tight spreads inside the base, which adds to the risk of the base. Most important point is, see, the next week is going to start on 15th of June. So let's go to the daily time frame chart of 15th of June 2020 and see what is the position of the moving averages. So this is the daily time frame chart. Okay. So the next day is going to be 15th of, this is 12th June candle. 13, 14 was probably Saturday, Sunday. So 15th of June would be Monday. Look on 15th of June, what is the position of moving averages? It's not blue, green, red. It is green, red, and blue, probably green, blue, red. Okay. The blue is the 50-day simple moving average. The green is the 150-day and the red is the 200-day simple moving average. So we need price to be above the blue, green, red. Okay, so we need the BGR combination. Here you don't have BGR. Here you have GRB. Okay, so that trade is not valid. We cannot take a trade. We cannot take a trade at the high of this bar considering this as the pivot point, because our daily moving average criteria is not met. Okay. Another thing I want you to notice, the base starts from here, right? What is the low of this candle? 139.50. What is the high of this candle? 139.02. What is the low here? 139.50. So there is a falling window between these two candles. So between the low of this candle and the high of this candle, there is a price gap. Okay. Falling window becomes resistance. So unless that window breaks, unless the low of this candle breaks, so which is 139.50, unless a daily bar closes above that 139.50 level, there is no point taking this trade, because we know that falling window is a very dangerous sign. Correct? So we have to wait for that. And by the time it happens, probably the blue line will move above the red and the green is already starting to move above the red. By the time it closes the window, probably the blue line already would have moved above the green line. So now you will have blue, green, red, and the price above the three moving averages. Moreover, all the three moving averages would be sloping up. Let's go to the weekly chart. Let's advance the price forward. You can't take a trade here, okay, because it doesn't meet our basic Mark-Minervini trend template criteria. So let us see whether the base develops further, okay. So I will move the price forward. See, by the way, if I remove these two, see, if you had taken a trade here, considering the high of this bar as the pivot point, you see this bar has closed below the pivot point. And remember what William O'Neill said on page number 261 in his book, How to Make Money in Stocks, fourth edition. He said that true winners don't close below the pivot point. This has closed below the pivot point. So there is too much risk. Even if you had bought the stock here, considering that this is the pivot point inside the base with a cup with handle, that would have been a mistake. You should not have bought there. Even if you had bought, you should have sold here all of your shares, okay, to control risk. And by the way, let us measure the distance. Let's say you buy here at the high of this. Look at this. It's already gone 7.5% below, and the chances are very good that you would not buy at the pivot, you would buy slightly higher than the pivot because you are buying in the blue zone. So from there, if you measure, it's already hit your 8% stop loss. So if you had bought there at the high of this bar, your stop loss would have been hit. Okay. That is why I say please look at the moving averages on the daily time frame chart before taking a trade on the weekly time frame chart. It is safer. Okay. You can take a trade on the weekly without looking at the daily, no problem. But you have to understand what risk you are taking. If you are ignoring the daily time frame moving averages, you are taking unnecessary risk. If you are aware of the risk that you are taking, no problem. But if you are not aware that you are taking a risk and the stop loss being hit comes as a surprise to you, then that is not professional. Let's move the price forward. See, now you have another handle. Okay. Yeah, see this. Now you have another handle here. After this, this entire bar has appeared below the high of this bar, right? So the high of this bar, which is 145.27, can be considered as a pivot provided by next week. So 6th of July 2020, the moving averages on the daily time frame chart are in our favor. So let's see 6th of July 2020. So let's move the price forward here. We want to look at 6th of July. See, the moving averages crosses here in June itself. So by 30th of June, the moving averages are already crossed. The blue line has already crossed the green line. So on 30th of June itself, you have the blue, green, red combination. So now in July, where is July here? So 6th of July. See, you have blue, green, red, blue, green, red. Price is above all the three moving averages, and all the three moving averages are sloping up. Fantastic. So our criteria is met here. So on when the next week when the stock is about to break out, the your criteria is already met. And by the way, the relative strength of this stock during this time and this time was more than 80. I think it was 83, 88. I forgot what it was. I just checked a few minutes ago. But I can tell you it was more than 80. This was an early stage base because of that corona crash. Okay. So let's draw the pivot range as usual. What is the high of this? 145.27. I will take out my old school calculator. 145.27 multiplied by 1.05. So 152.53. So let's draw that. Where is the rectangle? Yeah. Blue color. So this is 145.27 and this is 152. I'm not writing two decimals, okay? Next, let's draw the green zone. So this will be 145.27 multiplied by 1.2, which is 174. And this is 145.27 multiplied by 1.25, which is 181. And let's give it green color. Okay, that's the selling zone. Then let's do the stop loss zone. Red color. This is 145.27 multiplied by 0.92, which is 133. And this is 145.27 multiplied by 0.95, which is 138. That's it. The price is between the pivot point and the 10-week simple moving average. The moving average is on the daily time frame chart in our favor. Now you have 9 red bars, sorry, still 8 red bars inside the base, and not a single one of them is high volume. Correct? You don't have tight closings. You don't have tight spreads inside this base. That adds to the risk inside the base. However, it's an early stage base. It's a cup with handle base. The red bars are in our favor. So there are some points which are in our favor, some points which are not in our favor. Let's look at volume. Volume is 5.59 million average. So 5.59 divided by 5, which is 1.1 million. So on Monday, we expect 1.1 million volume to come, right? When the stock is breaking out. So let's see what happens on Monday. So on Monday, you get 1.3, but the price does not enter the blue zone. So you don't buy on Monday. Tuesday, the price enters the blue zone, crosses the blue zone, comes back and closes inside the blue zone. What's the volume? 5.71. What were we expecting? 2.2 million. 1.1 million on Monday, 1.1 million on Tuesday. So total we were expecting 2.2 million, but Tuesday itself it has crossed 5.71 million. So it has already touched the blue line on the volume chart, and you still have 3 more days to go. Wednesday, Thursday, and Friday, correct? Which means you would have bought the stock in 3 tranches. So when the stock first hit the pivot point, you would have obviously seen large volume coming into the stock. So let's say you buy 50 shares. Then you wait for another 1 or 2% rise in the price on high volume. You buy another 30 shares. So 50%, 30%, 20%. So chances are on Tuesday, you complete your purchase because of extraordinarily high volume. The volume is more than twice of what we are expecting by the end of Tuesday. So Wednesday, Thursday, Friday. Okay. Friday it has closed here. Has it closed below the pivot? No. Remember, true winners don't close below the pivot. It came very close to closing below that pivot point, but this is acceptable. You don't have to go into the exact closing price. This is okay. This is acceptable. It's not closed below the pivot. Okay, next. Monday, Tuesday, Wednesday, Thursday, Friday. By Friday, it has closed above the pivot, which is a good sign. Stop loss is not hit. Okay, probably your average execution price is inside here. Your stop loss is somewhere here or near to that 8% level. Monday, Tuesday, Wednesday, Thursday, Friday. Monday, Tuesday, Wednesday, Thursday, Friday. So on Monday itself, the stock hit. So I'll take it back. Okay. So see Monday, when I click here, Monday, the stock already crossed the entire green zone. So you got a chance to sell the stock in that green selling zone, correct? So let's say you take a 10% position size in the stock here, and you decide that you want to sell 1/3, just like our old trade management rule. So let's say you sell 1/3 somewhere here. So normally you would book 20% gain. So from here till roughly here, That's a 20% gain. Somewhere in the blue zone and somewhere in the green zone you sell, somewhere in the blue zone you buy, that's a 20% gain. Okay. So on one third of your position size, one third of your number of shares, you make a 20% gain. On the remaining two third, what do? You move your stop loss to break even. So on the remaining two third, your stop loss is at break even. What will you do with the remaining two third? You will sell one third when the stock closes below this blue line, and then you will sell another one third when the stock again closes below the blue line. Okay, let's see what happens. We will continue to move the price forward and wait for a close below the blue line. So let's move it forward. So for every bar, I have to click here 5 times. See, now it's coming closer to closing below that. See, what's the closing price here? It's 232.18. What's the blue price here? It's 233.25. Look here. On this bar, the closing price is 232 and the blue line is 233, which means here you have to sell another one third because it has closed below the blue line. So let's say you sell another one third here. What's the profit that you book somewhere here till here? That is 57%, 58%. So 20% here, 58% here. Let's continue to move the price forward. Let's see what happens. The stock again goes above the 10-week simple moving average. We still have one third in the stock. So look at this. Has it closed below the blue line? So closing is 258.05 and blue line is 258.49. Yes, it has closed below the blue line, but has it come on high volume? No, it has come on low volume. So the choice is yours. Here you either sell the remaining one third or you wait for a high volume close below the 10-week simple moving average. I would probably sell all of my shares there because it's been a long time that I have been holding on to the stock. So, for example, this is July and this is January. So, roughly 5 to 6 months, I'm in the stock and I'm getting like 76% return in 6 months. That's a fantastic return. And the stocks seems to be flattening out. As you can see here, after this, there are 3 consecutive bars which are below this, the high of this bar. So we might expect to buy the stock again. So it makes sense to sell here and buy it back again if this high is broken. So you could sell your remaining shares here with the hope that the stock might break out of this level. Okay, and you get a chance to buy. Similarly, you also get a buy point here, buy point here. But I am not discussing pyramiding in this series. I'm just discussing basic stock selection, basic filtering, shortlisting, stock selection, trade, position sizing, trade execution, risk management, and trade management. Okay. So assuming you sell here, you make like 76%. So what's your analysis, final analysis? On 3.33%, you made 20%, right? Then another 3.33%, you made 58%. And then another 3.33%, you made 76%, correct? That's your analysis. Simple moving averages. You are not using some rocket science trade management principles here. You are just selling one third at certain points in time. When it enters the green zone, when it closes below the 10-week, and again when it closes below the 10-week. Okay. So that would be 3.33% multiplied by 20% plus 58% plus 76%, which is equal to 3.33% multiplied by 20 plus 58 plus 20 plus 58 plus 76. 154. So what is 3.33% of 154? So 3.33% of 154, 5.12%. So 5.12%. So this is the amount of money that you make on your portfolio from a single stock, right? Imagine getting, so this is the return that you made in 6 months. Okay, imagine getting 5 or 6 stocks like this in a year. Let's say you get 6 stocks like this in 1 year. So how much will you make from such stocks on a portfolio level? You will end up making 5.12% multiplied by 6 is equal to roughly 30%. You would make this return on a portfolio level, right? Depending on what is the timing of the stock that you get. So the moral of the story is you don't need too many stocks in a particular year to perform for you if you want to generate a decent return out of the market. Just 6 stocks like this giving you return, like giving you 5% return on a portfolio in 6 months should be more than enough, right? Are you not satisfied with 30% return? What more do you want? Even 15 to 20% return in a year on a portfolio level is more than enough. 15% return in a year means your portfolio doubles every 5 years. 20% return in a year means your portfolio almost doubles every 3.5 years. 25% return, yeah, 25% return every year means your portfolio doubles every 3 years, correct? Less than 3 years. What else do you need, right? So you just need 5 or 6 stocks like this. And what trade management plan have you used here? Nothing, right? It's very simple. Whatever you did here, you just sold one third in the green zone, one third when it closed below the 10-week simple moving average, and another one third when it again closed below the 10-week simple moving average. And every time you sold, the volume was low. So you could have still held on to the stock even longer. But even this much return is more than enough. Okay. That's what I'm trying to tell you. If you are taking a positional trade on a weekly time frame chart, all you have to do is to open your TradingView application or your broking application every Friday at 3:15 p.m., just 15 minutes before the market is closing or 5 minutes before the market is closing. Just go to the weekly chart and see if the stock is closing below the 10-week simple moving average. If it's trading below the 10-week simple moving average. If not, let it go. So you are just keeping an eye on the stock every Friday. Entire week, you're not even looking at the stock. So the amount of return that you're getting for the amount of time that you're spending is extraordinary here. How much time are you spending on this stock? Nothing. What did you do in 6 months? You did nothing. Every Friday, you just checked whether it was trading below the 10-week simple moving average. And in most of the cases, it was trading above the 10-week simple moving average. So you did absolutely nothing after you bought the stock, right? So there is minimal trade management and a very good satisfactory return. That's what you want. So that is the benefit of weekly positional stock trading, trading on a weekly time frame chart. Only drawback is you've got to have that much patience. You have to sit with the stock for 6 months. You have to sit with this entire base formation. Okay, it is just very frustrating. Okay, you could have bought the stock. See, there is a nice cup with handle. Sorry, there is a nice flat base here. There is a buying opportunity here as well. But that's pyramiding. That's complicated. I don't want to get into that. Just basic trade management works. You find good stocks, buy them at the correct pivot point, ensure that it is early stage base, analyze the base properly, execute the trade properly, have a trade management plan before even the stock begins its up move, execute the trade management plan properly, and you are done. And make sure that you look at the moving averages on the daily time frame chart. What else should I teach you? It's very simple. Okay, don't make it complicated. Don't have too many rules. If you read William O'Neill's book, there is an entire chapter on selling rules. If you read that chapter, I can guarantee you, you will get confused. Okay, you will have to read that chapter 3, 4 times to truly understand what he's trying to say in those selling rules. I have read that chapter. I don't follow those rules. Okay, it's very simple. I just look at the moving average, or I just sell when I feel like selling the stock. What rules can you apply? I mean, if you apply one rule, then you are not applying the other rule, correct? And who knows what is going to happen in the future. So for me, the simplest of all trade management tools is the 10-week simple moving average. That is the main uh, guiding principle for me. Because if a stock is trading below the 10-week simple moving average or the 50-day simple moving average, we have no business being in the stock. Okay. I hope this video has been helpful to you. We'll do a few more charts. Okay. We will make sure this series goes till part number 50. I don't know what this part was, maybe part 46, 47. I don't remember. I forgot what part this is. But we will go till part number 50. Thank you so much.